In today's video, we're diving into the world of rates, from mortgage interest to credit card APRs. Rates are a key part of financial planning and understanding how borrowing or lending money works. But let's break down what these numbers mean in a straightforward way. First off, there is an inherent mystery about rates that often leaves people confused. Let's start by talking about mortgage interest rates. When you take out a mortgage, banks calculate how much extra money they'll make from you over time based on your loan amount. This calculation is called the interest rate. It can be calculated in different ways, fixed or variable, which determines whether it stays constant or changes with market conditions. But here's the catch: many people only see their monthly payment and don't understand what goes into calculating that amount. Mortgage rates include principal. Understanding how these factors interact can help you save more on your mortgage over time. Now, let's move on to credit card APRs. The annual percentage rate is the cost of borrowing per year charged by a lender. But what does this actually mean? Your monthly payments are based on the balance remaining at the end of each month and an average rate calculated throughout that year. Many people don't realize how their daily spending adds up to more interest over time. Most people miss this. Understanding your credit card's effective annual rate, which takes into account compound interest, can help you see how quickly those late fees or balance transfers might balloon if left unchecked. Then there's the concept of break-even rates. This is especially important for mortgage refinancing decisions where different lenders may offer slightly different terms and costs. Knowing how to calculate your break-even point when it makes financial sense to switch loans can save you a lot of money in the long term. Next, we dive into interest rate swaps. This is often done for large corporations looking to reduce their borrowing costs and manage risk exposure. The intricacies here can be quite technical, but understanding the basics helps in knowing when it's worth considering. The next piece of the puzzle involves comparing different rate offerings across various financial products like loans, credit cards, insurance policies, and more. Different institutions use varying methodologies to calculate rates, which makes comparisons challenging. It's crucial for consumers to understand what each term means so they can make informed decisions. In short-term lending such as payday loans or high-interest bank overdrafts, the interest rate is often expressed using a daily periodic rate because these products typically have short loan durations. Understanding this concept helps in gauging how quickly you could end up owing much more than you initially borrowed for. And let's not forget about inflation adjustments too. Many fixed-rate financial instruments include provisions to adjust the interest rates periodically. But here's a catch: often, banks and credit card issuers don't make these complex calculations easy to understand or accessible without having to be tech-savvy. It can leave people feeling overwhelmed and perhaps skeptical of their true cost. However, with some basic knowledge and tools, you can gain a clearer picture. As we wrap up our discussion on rates today, here's something practical. Consider keeping your credit score as high as possible. A higher credit score often translates to lower interest rates across many different financial products. In summary, understanding rates can be complex, but knowing where to look and how these calculations work will empower you financially. If you're curious about more topics related to money and finances, make sure to check out our other educational content. This is educational, not financial advice. Watch more here if you're interested.